Got a question the other day asking what's an important metric that I should study when I'm talking about real estate investments for essentially property when investing. And so I wanted to walk through what metrics I feel are important. And there's really three: cash on cash, which is sometimes called ROI, cap rate, and return on equity, which is sometimes called ROE. So when we walk through these, cash on cash is just like it sounds. How much cash are you making on the cash that you put in? So example would be on a $200,000 house, the down payment is going to equal 20%, which is $40,000. And if this thing makes $4,000 a year in income, profit, I should say, then this is going to be, if you divide if you're making $4,000 a year and it costs you $40,000 to get into it, you've got a 10% cash on cash yearly investment there. Hope that makes sense. Cap rate's a little different. It's going to use a metric of what the sales price is divided by the net operating income. So this is income after the expenses are taken out, not counting the bank expense. And so sales price divided by NOI. So if we have, what's a standard? If this property is $800,000 that we know, and its net operating income is $100,000, this is where you hear people say this is an 8 cap, 8%. So sometimes people don't know this metric, but they do know the net operating income and they know the general cap rate in any area. So then they use this to calculate the sales price. So hopefully that makes sense. Our last one is return on equity. Return on equity is my favorite real estate metric. It's not used a lot when you're negotiating, but it's an awesome one that can get you excited because this calculates in, it's kind of like cash on cash, but it also calculates in debt pay down. Because of course, if you're taking out a loan, you want the tenants are paying off that debt slowly but surely. It calculates in appreciation in your property. And this one also gives you, that cash flow is going to factor in here. So all these metrics factor in for return on equity. So essentially you take your cash on cash, if that's 10%, but then you add in the debts getting paid down and at 3% a year, and then you're appreciating by 3% a year, and then your cash flow is going to be 10. Roughly speaking, your return on equity sometimes can be a lot higher, and that can be exciting, and that's something that you kind of factor all three factors in. Not used as commonly. These two are definitely primary, but this one can be exciting for you to calculate what the power of real estate investing can be, because your asset's always gaining in value, usually in most markets, and then your debt's going the other way. So hope this helps. Quick hit real estate investment property metrics.